What is up, everybody? I'm back with another edition of the State of Bitcoin podcast. And shout out to everybody listening on those Fountain and Podcasting 2.0 apps and streaming me sats. I really appreciate it. Here's one comment from the last episode at Hodl Hard Money said, "Great guest, great podcast." When I had hashing to heating on. So if you didn't listen to that episode, please go back and give it a listen. And then also, before we get started, another huge shout out to my sponsor, Codl.co. That's CODL.co for if you use promo code Green Candle at checkout, that's GREENCANDLE at checkout, you get 10% off your entire order. So even after the new year, if your New Year's resolutions, get your Bitcoin off exchanges, do that with one of the great wallets out there, and then store your seed phrase on a punch plate from coddle.co. Get it for yourself and your favorite Bitcoiner out there. But I've got a very special guest, TXMC, host of Alpha Beta Soup. TXMC, how you doing today?
Doing great. Thanks for having me on, Brandon.
Yeah, it's great. I mean, I found you on Twitter. You have a great Twitter account with, a lot of various charts. I see you popping into spaces left and right. So, but for those who don't know you in the audience, why don't you go into a little bit about yourself and your background?
Sure. Yeah, I'm TXMC pseudonymously. Haven't felt comfortable doxing myself yet because you know how the internet can be. But yeah, I consider myself an analyst and a market participant, kind of just broadly. I don't. I am a trader, and I think that's why people know me as a trader. But I don't have a traditional finance background. In fact, I've never managed money or worked for a financial institution or a bank or anything. So all of my exposure to the markets has been through my own experience and through learning from others and kind of self-teaching. That's the way I prefer to learn. And I came into Bitcoin in the 2020 bull market for the last time. I bought and sold it a couple of times in the 2018 bear market, kind of in a hot hand way without having any idea what I was doing. And it took me a couple of years to really get serious and do some research and start to understand, what makes it appealing, why it's unique. And that was really kind of late 2020 for me, which kind of like late in the bull run. So my experience with Bitcoin has not been a full cycle yet, though we're getting close. And it's been a really amazing journey the last year and a half or so that I've been on Twitter, because I joined Twitter after I kind of started learning about Bitcoin. I wasn't on any social media, and I had a friend of mine who encouraged me to start posting some of my thoughts, my analysis, because he knew I was thinking about it, and he was already doing those things. And so I took the leap, made a profile, and then it just kind of took off from there. I am an analyst also in my profession, my fiat profession, but it isn't anything related to finance. But I do make charts and graphs for people. So that's kind of how I learned how to visualize data. And I convey topics about data to people who don't think about data as their job. So those skills have helped me then translate that to creating content about Bitcoin as I try to learn about it more deeply and try to understand the markets as we're in this kind of fascinating macro environment. Whatever I learn, I try to just put out there, to share with others, but also as like a sounding board, because I think Twitter in particular is a really powerful tool. I mean, you got some of the greatest minds in the world on there, and they will give you real-time feedback if you say something wrong or something they don't agree with. So I try to leverage that as much as I can, and it's gotten a decent amount of followers through that process, which is pretty exciting.
Yeah, that's awesome stuff. And I mean, your analysis is absolutely great. And honestly, I thought that you, just based on it, that you had like a traditional finance background. So it's pretty interesting that you don't. But, you mentioned that you got started in late in the 2020 bull run here with Bitcoin. So it hasn't been the easiest go for you here
No.
in this time. So, why don't you talk about that and like kind of your first experience, going through these massive amounts of crashes while you're learning, because To be honest, I think a lot of Bitcoiners are kind of in your same position here too, where maybe, they have a lot of net paper losses from that all-time high, but obviously just keep continuing to stack is really encouraging. So why don't you go into a little bit about just that experience, how it's been?
Yeah, and this is a going through a bear market is never easy, and anyone who's been in Bitcoin for more than a cycle can attest to that. But that's true even outside of Bitcoin. Anyone who goes through any kind of a bear market, it is a true learning experience. And I think that a lot of folks came to Bitcoin around the time that I did, or maybe a little before or after me, and have found now the market rolling over swiftly. And if you just rewind time back like 18 months, there were all kinds of narratives that were circulating in the community about how the market must continue to go higher. But looking back now, seeing there were so many different signals warning to us that in fact market strength was not as it appeared. Price had gotten far out ahead of its skis, and that the underlying strength of the market was a lot weaker. But the kind of fascinating thing about markets generally, and particularly bull markets, is that infinite narratives can be conjured to justify price action. There is always a new narrative to justify why price did the thing today. And the tough thing in a bull market is that some of those narratives can become really seductive, and they can start to have really long-term perspectives. I certainly fell prey to a little bit of that at times during the bull market. It's hard not to be seduced by some of these ideas that this time is the paradigm shift. This is the sound money revolution. And of course, none of those things really came to pass in the way that many Bitcoiners thought just yet. It's been a learning experience for sure. When I started buying Bitcoin, I didn't know that we were, a couple of months away from the peak of price. I didn't quite know what the markers were to look for to really understand that market specifically. My trading experience never really required me to do that kind of analysis. When I learned how to trade the markets, it was extremely myopic. It was focused on momentum in small caps in like pre-market and shortly after the bell, trading the level 2, watching the tape, and just really getting in and out quickly, little scalp trades. And you don't have to know very much about macro at all to make that strategy profitable and effective. And so that was really my entry to the markets. And so when I started learning about Bitcoin, seeing what was happening with the economy, with all the stimulus we were creating in the wake of COVID, all the monetary distortion that it was putting into the economy, it really kind of motivated me to start learning more. And I think that it wasn't really until maybe the end of last year, maybe December and maybe January this year, that I started to understand that we were not just in a correction. We were probably at the beginning of a more protracted type of bear market, maybe one that Bitcoin had never seen before, because through its lifetime thus far, it had existed in primarily a supportive macro regime, and that seemed to be shifting. And so this year has been an amazing learning experience, a kind of a turn of phrase that I use to describe these things. Markets are a savage Darwinian beast, and they teach in the most ruthless way possible. And unfortunately, for most participants in the market, you have to learn in the hardest way possible. You can't just have someone tell you, hey, you should do XYZ with your assets. Hey, I think the market's going to do this. In the end of the day, people will make their own decisions most of the time. And for a lot of folks, they have to learn by going through these market phases. And so right now, I think everyone, myself and any other Bitcoiners, and really anyone else in the market, but we're talking about Bitcoin specifically, we're paying our tuition right now. It is levied upon all applicants without exception. We're all paying it right now. And we will all be stronger for it, I believe. This has been a really kind of interesting year to become macro aware. And I think that Bitcoin is going to be at the center, at the nucleus of the story of monetary distortion as we go forward through this decade and the decades beyond. I think Bitcoin will kind of be at the apex of responding to those oscillations in the economy because of the nature of its design and the way that it reacts.
Yeah, so I mean that's a really interesting point, and you're bringing in that traditional finance kind of trading aspect from it, but what you're saying here, or at least what I'm kind of reading into, is that Bitcoin isn't really like any other asset that we've kind of ever seen before, right? Because it's 24/7 trading or kind of movements, volatility, very violent swings in either direction when it comes to very specific macro events and events that you know obviously like Bitcoin can't control, and obviously there is no CEO or anything like that of Bitcoin, but there are so many outside factors that kind of bring it in. I mean, I watched your latest video on the FTX debacle, and there's some of these other things that maybe it might not even be completely related to Bitcoin at all. I mean, like, right, FTX is a company, but that crashing sent Bitcoin price down dramatically. And, all these other exchanges, when they shut off withdrawals and other things like that throughout this year, also set, Bitcoin kind of down price action wise. So, as somebody who's kind of just like analyzing the price and kind of analyzing these macro events, how do you analyze for that, or even like look into to something like that, compared to your background as looking at traditional companies where maybe you only had to worry about a Tim Cook at Apple, or you only had to worry about something else, where some of these macro factors, like you said, aren't as I guess dramatic or as important as maybe they are to Bitcoin.
How do you factor in like things like the FTX collapse?
Yeah, well, I mean, factor in maybe more, maybe not FTX collapse specifically, but some of these more macro events, right? Because we're getting like the Federal Reserve raising interest rates. We're getting a lot of these, like you said, kind of macro events that
Mm,
you never really had to pay attention to. But it seems like all eyes are on the Fed these days. All eyes are on the monetary policy. Some of these
yeah.
like outside factors that really just don't go against the Bitcoin fundamentals, and it's more so, I guess, an entire market move opposed to just a
Yeah.
Bitcoin move specifically. So how are you guys I kind of looking at this overall like macro environment, whether it's companies or the Federal Reserve, kind of, I guess, almost like pulling these strings, right, where we're seeing
Mhm.
these kind of violent swings in either direction.
Yeah, the we're definitely having people in Bitcoin space are having to pay attention to more elements of the economy and the markets than they had to in the past in order to be successful as a Bitcoin investor, right? And the thing that I think it's important to point out is that all of these factors that we feel that we now have to care about have always mattered. It's just that they are now conversely against the grain of what people are hoping price action will do, right? And so those factors have been broadly supportive and accommodative for 10 to 15 years, and in many ways they're now changing. There have been brief periods where the Fed and the Monetary Authority tried to kind of cool the skis a little bit. In 2017, 18, they ran QT for a little while, and then they were swiftly rejected by the market, and they had to stop. And I think that reaction has been expected. I mean, you can see that kind of Pavlovian expectation that people think that any amount of pain that the market endures is going to be saved by Papa Fed, and that reaction is specifically what they are trying to break down actively this year. And it's when you think about interest rates have always played a factor in Bitcoin. Bitcoin is a highly interest rate sensitive asset class, especially to short term rates, and it always has been. And but it wasn't until we got to this year when the authorities started using rates as a tool against the market in an effective way that it started to actually matter. And they started raising rates at maybe the most aggressive pace in history. That also plays a role. But there's other elements of the economy that have been sympathetic to Bitcoin's price action forever that we can look at, and they can corroborate that what we are seeing in the price action makes perfect sense right now. And one of those is credit conditions broadly. So like you can look at, I've posted this chart a few times on Twitter. You can look at high yield corporate credit spreads versus Bitcoin bull and bear markets broadly. I don't mean on like a weekly basis or even a monthly basis, but in a macro trend sense, credit spreads widen, they get broader, the yields rise in bear markets for Bitcoin. The spreads tighten, yields, the credit yields get narrower, the conditions are more supportive, there's more liquidity flowing in bull markets for Bitcoin. You can see those oscillations. And I think that really shows that it is a liquidity sensitive asset. And it wasn't until the removal of liquidity from the market that it started to behave. Everything really kind of became correlation one, which is something you were mentioning. Everything's kind of one trade this year. And everything has become so liquidity sensitive that the removal of it has now forced everything to move in one direction. And, when you look at, like I said, we look at credit conditions, Bitcoin has always followed those. Same thing with PMIs, which is not so much of a liquidity function, but more just expectations of business conditions, new orders and employment and things like that. If you look at the PMIs, the oscillations of those from 2010 to now follow the Bitcoin bull and bear markets. It's everything has always been sympathetic to one another. And I think that over the last 10, 15 years, there was so much monetary debasement. Interest rates were kept artificially low for an exorbitant amount of time. And so Bitcoin was allowed to kind of create its own narratives. It experienced some bull and bear markets. And in those times, stocks also saw some brief bear trends, though it wasn't a full breakdown of the secular bull. And in those brief bear trends, Bitcoin saw steep bear markets, partially because of its inelasticity to demand, right? Because the supply doesn't change. And so that sort of liquidity, as I've heard Michael Cow call it, it goes both ways, really. So like when we get to demand spikes because of that inelasticity, price can move really dramatically. But at the same time, when that demand goes away, there isn't that kind of converse supply effect. And so price can fall really swiftly. And so Bitcoin's always been really liquidity sensitive. I think that it's become more obvious this year. And I think when we start to move forward, this learning experience, I hope, helps to mature the class a little bit. There's going to be investors that don't learn. There's going to be people who get greedy and they ape into things in the next bull run. Those things won't change. But perhaps broadly as a space, we can start to understand that Bitcoin is a macro asset. It has always been a macro asset since the beginning of time, largely because what it is priced in, the assets that we acquire Bitcoin with, those assets are highly sensitive to market conditions, to liquidity, to interest rates, the things that we are pricing Bitcoin in. So as a natural byproduct, it is affected by those things. And I think that, like we mentioned earlier, when you're in the bull and all of these narratives are conjured to justify price, it's really easy to think that this amazing monetary innovation is somehow capable of doing its own thing, even at this young stage of its life. But we've learned this year that isn't true yet. Maybe it will be at some point in the future. I would argue perhaps not, but it's been very, very obvious this year.
Yeah, and you said you'd argue perhaps not, but let's kind of get into that point because there's always been kind of the narrative around Bitcoin Twitter that Bitcoin will eventually decouple itself from like growth stocks, right? But right now it seems like we've kind of said and gone back and forth is that it's pretty correlated, right? I mean, like we've seen the growth stocks shoot up, we've seen them come crashing down, and Bitcoin for the most part has kind of generally followed that path. But there is one thing that I think is pretty encouraging right now is that even though I feel like growth stocks are kind of still on the way down, maybe not as dramatic as Bitcoin, we've kind of had this sideways motion here of around maybe 16 to 20K for Bitcoin. And, granted, the stock market's kind of stayed around there as well. So, how do you view the decoupling, so to speak, from the stock market? Do you think that that's going to kind of continue to happen as more Bitcoiners come in and, hold their own private keys, take it off exchanges? Is that a trend that you're kind of looking at and analyzing? I mean, I know that's two pretty big questions, so I'll go ahead and go into that right there on how you view just the decoupling from growth and various stock market trends or whatnot, and some things that you're looking at Bitcoin related to that.
Yeah, the coupling conversation is pretty funny. It's good to talk about it, but it's also it's almost it's almost become like a trigger word on Twitter to talk about decoupling. Um, Time frame matters, I think, and a lot of times when you see new tweets about decoupling, it's usually on a pretty low time frame. Um, Certainly, the correlation to the Nasdaq has been increased in the last couple of years from where it was before. But as I was trying to articulate a minute ago, the bull and bear cycles have always kind of followed each other broadly. The stock market goes up when Bitcoin's going up, stock market's going down, or sideways when Bitcoin's going down. Those things have always kind of broadly been true, and I think that um, when you have catalysts, exogenous factors affecting the markets, Bitcoin gets a chance to react first a lot of the time. And so that can create this idea that it has decoupled when in fact it made its move at an earlier time, because it's 24/7, 365. Markets are 252 days a year for 8 hours a day. So you only get a window of time in which the market the traditional market can react to these exogenous factors. And it does it in a very systematic way. There's a lot of portfolio balancing. There's a lot of cross current flows that are affected. So it happens in a kind of systematic way. Whereas Bitcoin, it's a free market. It's its own enterprise. It can react in the moment as much as it feels it needs to whatever's happening externally. And so I think that disrupts some of the correlation arguments that we make when you look at it mathematically, when you like run a correlation test over Bitcoin and like the S&P. I think some of those differences can mess that up. But broadly, we know that they've always kind of followed each other. And I think that when I think about into the future, and I'm open to being wrong about this, and I'm open to hearing how I could be having this, how I could be mistaken on this. But it seems to me that if Bitcoin is going to continue to mature as a monetary asset, it would make sense to me that it would become more correlated to the markets, not less. If it's going to become a successful monetary unit, then you would expect some amount of commerce to be priced in Bitcoin at some point, right? Some aspect of an economy somewhere, people are using Bitcoin to buy other things in some regard, whether that's buying back into fiat because they're using it as a hedge, or because it's actually the unit for like an energy market or something. I'm just throwing out examples. You would expect that to happen. And because it is a money, right? And someone will start using it as money. There are places in the world that are using it as money now. If that's going to continue, and I would expect its profile as a monetary unit to become more closely related to other markets, because it becomes a pricing unit for other things. And as a result, it is sensitive to the conditions of the economy and less sensitive to what Bitcoin itself is, right? Because Bitcoin is relatively unchanging. And so we're just kind of waiting on the maturity factor, the adoption factors to kind of percolate. And I think that when I think about that going forward, if Bitcoin's going to be used more and more as a pricing unit, as a denominator where its strengths can be realized, where its protection of buying power can be exercised, it has to have things priced in its own native units. And that, in a sense, will make it very responsive to exchange rates, to interest rates, to monetary policy in various currencies. So I think that the correlation should be naturally expected to become more close knit as Bitcoin matures rather than going the other way.
That's a really interesting point, and kind of the first time I've heard that, and it is. I think it is pretty timely right now because we are seeing a dramatic bear market not only in Bitcoin but obviously in the greater markets. And I think the narrative, this year, I don't know if I hadn't really been on Twitter, Bitcoin Twitter, I guess, for other cycles, but the narrative going around here, I know I saw Dan Held and some of the others, was there was going to be this great super cycle,
The
right?
super cycle.
Yep, like it was just going to keep going up and it wasn't going to be as volatile, but it'll keep going up. But Now we're in the longest bear market in Bitcoin's history.
Yes, we
Granted,
are.
it is a short history. So, I guess how do you view, I guess, these 4-year cycles now?
Mhm.
I know you've kind of talked about how it's somewhat correlated with the overall market. Do you kind of continue to think that Bitcoin is going to go in these 4 years ish cycles just based on the properties of Bitcoin when we have the halvings and other periods like that, or do you think it's just going to kind of be, I guess, a little bit more correlated to some of these market cycles? So say for example we see a decade of growth, we might see a decade of growth in Bitcoin relative to fiat price.
Yeah, bubbles will continue to occur. Mini bubbles, big bubbles. Those things have always existed, and I think that the idea that Bitcoin would stop having cycles, um, I think is a little silly in the sense that uh, markets have always been cyclical, right? For centuries, for generations. So that's not something I see changing. I see that pretty simply, but I do think that super cycle argument is interesting, and that's one of those examples of a narrative that is born out of a bull market that people can magnetize toward, that makes them feel warm and fuzzy. But if you start to pick it apart and you really put a critical eye towards it, it's hard to defend it in the real world because there aren't very many examples that you can use, right? And history is a way of rhyming. So we've seen, unless you're going to make the argument that this specific market, this one time is different, and you have evidence for that, it's hard to justify it, in my opinion. And so I think that it it was a bull market narrative that we have now found to not be true. As you said, we're now in the technically the longest bear market of Bitcoin's life. If November 21st was the low price, and we consider that the end of a bear market, just kind of technically high to low, then that would have been just a little shorter than the 2013-14 bear market by about 4 weeks. But if we consider that this bear probably still has further to go, then we are now in the longest bear market in Bitcoin's life. And it's the first one that is experiencing a bear market in traditional markets as well, in the bond markets as well. I mean, everywhere is having a bear, right? And so that kind of cyclicality, I don't think will change. I do think you could see an argument, and I think that maybe I can't speak for Dan Held, I don't know him, but I think that maybe some of that argument that he makes comes from just this kind of long-term debt cycle perspective, the Ray Dalio, kind of big debt crises, long-term debt cycle perspective. You could say maybe we're kind of near the end of one of those. It certainly appears that we're at the end of a long-term debt cycle, and that as a result of that, maybe these smaller, like the next 3-4 years, maybe it does look a little different from the prior 3-4 year patterns we've seen. But I think that as far as Bitcoin goes, I think that its 4-year cycles have been a bit serendipitous. It's been perfectly aligned with some external events that have made it seem as if Bitcoin and the halvings were doing their own thing in their own little vacuum of space. But I would make the argument that perhaps it was just a kind of a convenient aligning of unrelated events. So, what do I mean? So, like, if you think about Bitcoin's life and you think about the dating of the halving events, two of the halving events occurred within a couple of months of QE beginning, the 2012 halving and the 2020 halving. The 2016 halving occurred at the end of a kind of bearish correction in equities. It was when Trump got elected. Interest rates started rising in early 2017, and the markets started rising in early 2017. And Bitcoin started rising shortly after a halving, and that began the 2017-18 bull run. And when you look at those events on a chart, it looks like the halving is creating bull runs. But when you consider everything we've been talking about, and I'm not trying to diminish them because I think that they can create a hype factor. There is a narrative there. There's a reflexivity of the halving that creates some amount of demand. So I'm not going to try to diminish that. But what I'm trying to articulate and give people things to think about on are that if you look at Bitcoin's events, if you look at those three halvings, two of them are extremely close to significant exogenous factors, quantitative easing. I think QE2 was in 2012. I don't have the timeline in front of me. The Yardeni research guys have a really awesome website that has all the timeline, and you can go look at it on there. I've posted a chart on Twitter a few months ago where I lined up the halvings with these QE events and with that 2017 event where interest rates kind of hit a low and then began to rise, because interest rates naturally slowly rise in a bull market, right? Over time, right, rates rise until they kind of reach a breaking point, and then we have a breakdown in rates. But that began around the time of the 2016 halving. So we have three halvings lined up with three unrelated to Bitcoin events that all created bullish price action outside of Bitcoin. But Bitcoiners have blamed all of it on the halving, or have credited, I should say, all of it on the halvings. And I just think that that's a unfair credit. I think that these other factors are significant, and they have always been significant. And so when I think about what a halving represents, the halving represents a cutting of issuance, of daily issuance. Well, we have 90% of Bitcoin supply currently circulating. So we are thinking about, on the next halving in 2024, cutting daily issuance from 900 roughly Bitcoins to 450 Bitcoins a day, when we still have 92% or something of the supply in circulation. So I think that the effect of the daily issuance that the halving has is pretty much only a hype factor now. Because the other point I will make, and then I'll come up for air and let you respond, is there is a belief that when you cut issuance in half, that somehow increases the impact of a single dollar of buying power on Bitcoin, or that it somehow makes it easier for price to go up. But those things aren't remotely true, because issuance is not connected to the price in a direct way, right? You could say that maybe a miner, they just won the latest block, so they sold their 12 Bitcoin or whatever. Like you could make that argument, 6.25 Bitcoin. You could make that argument. But the liquid markets, where price is determined on a daily basis, are not having their liquidity supplied by the daily issuance of coins to miners, right? The liquidity in the market exists at all times. It's there now, with the 90% of supply that is there and the people willing to transact with it today. That's what's determining the market. So when you have a future issuance rate that is cut in half, that's very interesting. It's a technical marvel. It's a unique event for Bitcoin, but it isn't a mechanical driver of price action as much as perhaps an emotional one. And that's just the kind of thought process that I want people to have when they think about it, because I think that the narratives that have been built around the halving and the 4-year cycle as a result have some flaws in them. And those are the ones that I see.
Yeah, and I mean, I think there's a great point outs, and I really appreciate, kind of you going in and going on that little rant there, because I mean, I agree with you there, because when you really take a step back and look at it, like you said, it's only less than 10% of the overall market is affected by mining at this point in time. As majority of the Bitcoin that'll ever be mined are kind of in circulation at this point, whether it's in cold storage, what have you. But there is something interesting that's kind of gone on this bear market that hasn't happened on the other two, and that's the increasing of the hash rate for Bitcoin miners. And so, obviously we just kind of had a lot of miners shut off in Texas and some other places because of the harsh winter conditions to kind of help the grid. But, for the past, I don't know, 4, 5, 6 months, the hash rate has been kind of steadily increasing. Granted, like I said, it just kind of topped off in maybe around November time, and then kind of started coming down. But how do you view an event like that, where obviously mining is a huge portion of Bitcoin, the network, and everything like that? But as we've kind of gone through this past 5 minutes or so, the mining and the way that it works right now is that there's only really affecting 10% or so of the market. And so, whether that's these miners coming in and selling some of their profit and what have you, some of their mining rewards and whatnot. But how do you view, I guess, the overall hash rate kind of continually increasing during this bear market, even though the price is kind of, I guess, stagnant, for lack of a
Mhm.
better word?
Yeah, it's putting a lot of pressure on the miners. They are getting it from all sides right now. So they're screwed right this moment because the thing that generates profit for them is 75% down from the all-time high. They are short energy costs, and hash rate continues to rise. So their share of the market is shrinking. The price of the Bitcoin is shrinking, and energy costs are higher than they were a year ago. So miners are really getting squeezed. The hash rate itself is interesting because you're right, it has been going up, but it goes up in every bear market. There is a capitulative time at some point in every bear where a bunch of hash goes offline. It's kind of that breaking point for miners that you're talking about, where we always see a wave of selling. Some machines get shut off, some people go out of business, and they never come back. But then usually right after that, hash rate starts going back up again. It did that in 2018, almost right at the low of price. And that was around the bottom of the pullback in hash. We saw something similar to that this year. I don't have any kind of unique alpha on what I think's going on with the hash rate, but I do think it's pretty clear. There are some people out there who are either cost insensitive as far as electricity goes, or they are actively trying to squeeze out market participants, miners in the market. That seems to somewhat be going on, and the reason I think that is because you hear about a lot of this hardware that's just sitting around, right? That a lot of these people have, that's been shut off, but yet we still can see hash rate rising. Some of these machines, some of these S19Js and stuff were going for like $15,000 a year ago, and they're now $800-900. Like, that market has been roasted. I think we probably still have some more mining pain to go through. I don't know how much more forced selling there is necessarily, but hash rate does rise in bears. I think it will continue to rise. I don't think that we're going to see a period where hash just stops continuing to accumulate over time. That I don't. What I don't know though is where this hash is going, like what kinds of entities are acquiring it, if maybe they already had these machines or if they're scooping up a lot of these ones that are now on 90% discounts. I don't really know. People have rumors that some of this hash rate is in Russia, that it's in all these different places. I don't know how easy it is to verify those things. But I do think it's pretty interesting that we continue to see it going up. And some of these public miners had really weak business models. I think it's no surprise that Core Scientific filed bankruptcy. When I was looking at their debt to equity ratios about a month ago, they had a debt to equity ratio of 18, and the next worst public miner, was a 3. So like the writing was on the wall. They took out far too much debt, and the markdown of their assets is nowhere near what they owe. So I don't know if I have much more to add on it than that, but yeah, I think that this has been a really rough market for those public miners. I don't know how many of them will survive, but hash itself is still a commodity that is in high demand, as we can see.
Yeah, for sure. And I think you're nailing it on the head there. And I think, the point about the business models is just, yeah, absolutely correct too. I think a lot of these miners, it's interesting because you see that a lot of these miners want to hold on to their Bitcoin, hodl their Bitcoin, right? And
Right.
I just think from any other kind of industry, whether it's oil mining or gold mining or, something along those lines, those companies try to distance themselves as much as possible from that asset. Whereas in Bitcoin, it's kind of celebrated for some of these miners to hold on to their Bitcoin, and they kind of, have to ride with the tide. And, whether it's everybody's kind of jumping in, jumping up and down when this bull market's going up, and a lot of these companies are kind of either FOMOing in, buying Bitcoin, holding on to it, saying Bitcoin's going to the moon, what have you. And then they didn't prepare for this prolonged bear market,
Yeah.
unfortunately. So it seems like a lot of them are going to kind of go under as well. So I mean, granted, some of them already have, and I think that trend is going to kind of continue. But there's a lot of we've kind of alluded to it throughout this conversation. A lot of like interesting macro events, right? So we're all kind of self-taught here in the Bitcoin land when it comes to the macro events. So,
Yep.
I'm going to put you a little bit on the spot here as to how do you think the Fed's going to react in 2023? There's a lot of narrative around there about the Fed pivot, and we'll get into, I guess, my viewpoint on that maybe a little bit later after yours. But obviously we've seen the Fed raise interest rates at, like you said, a historic pace at this point, and Bitcoin and other assets have kind of reacted to that, and they're kind of trying to pull these strings, pretty violently to try to combat inflation. Although it's already, kind of been here. We've seen the CPI prints at obviously pretty close to all-time highs for such a long time, and I think the latest one was around 7.1 if I'm not mistaken. So
Mhm.
how do you think what's your overall outlook of 2023 as far as it comes, like, the Federal Reserve and how some of these policies they're gonna, I guess, pull, and maybe your view on the narrative of the pivot?
Yeah, that's been. I feel like if there was a word to describe FinTwit in 2022, it was pivot. That was the thing that I saw people talk about the most and had the most various takes on. Uh, I won't try to pretend like I've got it all figured out, right? I certainly don't know. This is the most complicated macro setup that anyone alive has ever tried to analyze or evaluate. Plain and simple. It is the most complex, most or sorry, what am I trying to say? It has the most moving parts. So as far as the Fed pivot goes, like there's a lot of conversation about what is their real agenda. Are they actually trying to destroy the markets? Like I want to put some of those aside because those are kind of hard to quantify. The actual like human intent behind it. All we can really go on are the measurements of the economy, what they say they're doing, and what we see them doing historically. Right? Those are the things we can actually sink our teeth into and use. So let's talk about those things. So the Fed's trying to fight inflation, a supply driven inflation problem for which they have no material solutions, right? And I think that they've kind of admitted that. They've admitted that throughout this year. When I say they, it's mostly Jerome Powell. He said it numerous times. There's very little they can do about inflation. All they can really try to do is beat on the economy and make it slow down enough that then, as a byproduct, inflation cools off. But what they're really focused on more than inflation itself is the expectation of future inflation, right? Because that's what affects people's behaviors. That's what affects wages. That's what affects people's investing and spending and saving behavior. So like that's really what they're trying to manage. And so whether they're super effective in their interest rate policy or in their QT at actually solving inflation quickly, I think matters less than the appearance that they are taking it seriously and willing to take extreme measures to do something about it, right? They want to appear as if they are willing to go the hard route because they don't want people to just assume that inflation's here to stay, because that is actually a death knell for a central bank. They don't want that. So they're going out of their way to try to avoid that. And I think when you create 40% of all the money in existence in an 18-month window, it's reasonable to then get really scared that you might create a catastrophic inflation problem. They reacted far too late to it as well, right? They were still talking transitory at Christmas last year, when inflation was 6.5 or something like that. So they definitely got it wrong, and I think that there's an aspect of face saving going on here as well, right? They have to maintain their own credibility in order for the market to even care at all what it is that they have to say. And when you look back at what Paul Volcker dealt with in the late 70s, they were using 10-year rates as a proxy for inflation expectations because they didn't have a tips market back then. And even though they were raising the Fed funds rate, 10-year yields just kept rising and rising and rising and rising until like 1981 before they finally turned over. And it was showing the Fed at the time, and remember that Powell is a huge Volcker fan. He's read his book. He used to carry his book around at the Eccles building and hand out copies of it to people. He thinks that he is a young Volcker. He was friends with Paul Volcker. It was his mentor. And Paul Volcker saw a market that did not believe in the credibility of the Fed. It believed in long-term inflation. Rates continued to rise. Long-term rates continued to rise even as the Fed was trying to combat inflation on the short end. And Powell is trying to avoid that. And so that's what we've been dealing with all this year, you know? And I think that there's a lot of expectation that they would be forced to pivot, that something was going to just imminently collapse and that they would be forced to come back to the market with their tail between their legs, provide the liquidity that everyone thinks that we must have in order to move forward, and that it would just be another charade like the Powell pivot in 2019. But we haven't gotten that. And I don't think we're going to get it that way. Part of the trouble, Brandon, is that like the monetary distortion is at max intensity right now. You know, the Fed thought that when they raised rates from essentially 0 to 4% in 9 months, that would create some jobless claims. But if you look at the 4-week average of initial jobless claims, it's basically where it was in December of last year. It's basically flat for an entire calendar year. And we've been seeing jobs. We've been seeing tech layoffs, particularly a lot of layoffs in the tech sector. But we also have a lot of job creation. We still have wages rising. And so that there's still a lot of strength left in the economy, an economy that is still expanding, even as we have recession signals flashing everywhere. We have an inverted yield curve, very inverted yield curve. There's a lot of other signals, the turning over of housing, the contraction of PMIs. There's new orders contracting. There's a lot of things that say, hey, we're in the middle of a long bear market. We're going into a recession. These things happen in a certain order, and the first series of things started to happen. But because of all the money they created, because we have generational changes to the labor force where there's just simply not a lot of willing supply, all those factors are warping the Fed's own desire to soften the economy. And that is pushing out the timeline of a pivot longer and longer. You know, people thought it was going to be in September. I remember the Luke Gromans of the world, who I respect. We follow each other. I talked to Luke, great analyst, but he was dead fucking wrong in Q3, excuse my language, when he was telling everyone the Fed was going to have to pivot because the treasury market was going to go illiquid. You know, you saw the MOVE index and it was basically at 2020 highs, but that never happened. It didn't materialize. What happened in the gilt market in the UK never quite came over to our shores. And so those things haven't materialized. And I know I'm going on and on here, but I think that it's a big picture to try to paint. And it's made it very difficult for folks who are trying to call these things in a timely way to try to say, this thing's about to happen. The Fed's going to have to turn here. They're going to have to do this. Oh, interest expense is getting too high. Oh, they're in a debt spiral. They have a bunch of ways that they can continue kicking this can further than anyone thinks it's possible. And even though we're looking around and it looks like we're at the end of a long-term debt cycle, it looks like the dollar is about to destroy all other currencies. You know, it feels like the economy is you know, in a blow-off top in a way. We're still moving. We're still expanding. People still have jobs. Everyone who wants a job has a job. And there's a lot of people who just don't feel the need to work at this time for whatever reason, right? We see that in labor participation. We see that in early retirees who have not come back to the labor force the same way that older workers stuck around after the great financial crisis. We haven't had that same effect. Those workers are now 15 years older. They don't feel like sticking around, you know? So if there's a lot of generational changes labor-wise that were already going to happen. And then when all of the monetary distortion happened as a result of the pandemic, they really kind of melded with what was going on with labor. And they've made it so that now the signals the Fed is using to determine when to turn the liquidity spigot back on, all of those are very distorted and they're taking much longer to play out. And now, you know, the last thing I'll add, just to show how messed up the sequence is on this bear market, you know, we have housing rolling over, which is usually one of the first things. We had PMI new orders go contractionary. That's usually like the second or third thing. And then after that, usually we have earnings rolling over. We haven't seen that at all. And in every bear market going back a century, the Fed was done tightening before the top of the market. But this time, they started tightening after the top of the market. The top was in January, and they started hiking in March. So this sequence is heavily distorted. I don't think a pivot is anywhere close. I think it could be deep into next year. It really depends on if we have a credit event of some kind. That's impossible to predict. But outside of a catastrophic credit event, it seems that this economy has many more months of resiliency left in it before it starts to look bad enough that the central bank, by its historical standards, would feel the need to step back in. And that would require much higher unemployment, first of all. We're just not there.
Yeah, no, I mean, and I agree with you too, because I think, I'm kind of glad you went through that whole spiel too, because I think that a lot of people think that just because based on the stock market that the economy isn't doing, what it, I guess, what
Right.
it should based on the people pulling the strings. And, I think that FinTwit maybe is this bubble, and maybe I'm just ignorant because I spend a lot of time in the FinTwit, big Bitcoin Twitter area of Twitter, and that all these people are kind of screaming for it. But I think in the real world, there's still, some more pain to be had, unfortunately. And Powell just keeps kind of doubling down on it every time he kind of goes in front of the masses and speaks about it. He always mentions, there's going to be more pain. There's going to be a slowdown, but I think that there's still going to be, increasing rates. And, people think, I think that the market might react, pretty crazily once he pulls it back and maybe raises by 50 basis points or 25 opposed to the 75 that he's been doing. But,
Mm-hmm.
In reality, that's still a pretty extreme hike, based on historical data. So, I still think, like you said, it's still a long ways to go. And I don't think that we're going to have a pivot anytime, maybe in 2023 or anytime, soon,
It's
maybe.
possible.
Yeah, I mean, I think that if anything, we're just maybe going to have a slowdown, and that's really it. And so, for all those people screaming pivot, I don't want to sound, I guess super bearish and negative, but I think at the end of the day, like the Fed doesn't care about the stock market or Bitcoin or anything like that. They're just caring about, the overall health of the economy, which, it all doesn't necessarily revolve around that, unfortunately.
Yeah, and like there are arguments to be made that they can't do this forever, and one of those is the kind of the debt trap, so to speak. That there is a point when they probably have to monetize deficits that are essentially required to continue expanding because of entitlements and things like that. And so that there is a future path where all their tough talk will run into the cold reality of math. But I think that finish line is further out than anyone really thought possible. And you said something a minute ago, Brandon, that tickled something in my brain. Like the stock market and the economy are related to each other. I mean, particularly in an economy so financialized that has so much consumption driving GDP. However, they don't have to go the same direction all the time. And in fact, there was a bear market, a recession, I should say, because it wasn't a stock market bear market. But we had a recession in 1945 where the stock market went up the entire time and unemployment stayed low the entire time. But it was an economic recession. And it was partially because of some of the lifting of price controls and people returning home from the war. And there was kind of a lot of economic turbulence there as we settled back in after war. But we had a very weird recession where unemployment didn't really go up very much. The market kept climbing the whole time, but the economy saw a drawdown. So those things can go in different ways. Just like this year, the economy has continued to expand while the markets have been going down. It's kind of the opposite effect.
Yeah, for sure. And I agree with you 100% too. So, but you've been very generous with your time, and I really appreciate you coming on. I think the audience is going to love this as we've kind of broke down Bitcoin and the overall macro talk. And I feel like I could talk about this stuff for hours. So I really appreciate it. But TXMC, why don't you tell everybody where they can find you and what you got going on?
Sure. Really appreciate the conversation. I love talking about these things. I could probably keep going for hours. You can find me on Twitter at TXMC Trades. And I am also on YouTube. My channel name is Alpha Beta Soup. You can find the link in my bio on Twitter if you don't want to go to YouTube. I post a lot of my analysis on YouTube, but I also tweet a lot of charts and things. So really, both places are good areas to find me. Yeah, that's about it. Happy to come back any other time.
Yeah, we'll definitely have to have you back on at some point in time, and I'll link both of those in the show notes, the Twitter account and his show Alpha Beta Soup. You should definitely check it out. So I give it the green candle stamp of approval. So TXMC, thanks
Yes.
so much, man. Appreciate it, and yeah, we're gonna have you back on at some point in time. So you've been awesome.
Thanks, brother.